You see the physical presence of massive companies every day, like a Tata Motors dealership with rows of steel and glass assets. In the real world, these businesses feel stable and grounded. Even high-speed services, like Zomato, are tied to physical actions, like a driver packing an order and hitting the road. It's a visible, understandable part of the economy. But the moment you look at the stock prices for these same companies, that stability vanishes. The numbers on your screen bounce up and down every second, flashing red and green in what looks like a blur of noise. It creates a massive dilemma. If the market is this erratic, how do professional traders actually predict the next move without just throwing darts at a board? The secret is that they've traded the dartboard for data analytics. Pro trading relies on stripping away the noise to find the underlying math. They do this using technical indicators, calculations based on the price and volume of a stock. Think of these indicators as a financial weather forecast. Just as a meteorologist tracks air pressure to predict a storm, traders use these tools to measure market momentum and prepare for the next shift. When viewed through these instruments, the market stops looking like a game of chance and starts looking like a complex, predictable system that can be forecasted with the right data. To make those forecasts, pro traders ignore the emotional headlines of the day. Instead, they focus on feeding years of historical stock data into their own custom systems. We're talking about massive scale, millions of individual price points, trade volumes, and timestamps stretching back through decades of market history. Processing that much history requires specialized code. Many traders use PineScript, a language designed specifically to build algorithms that can digest this mountain of information. This is the engineering in action. While a human would be overwhelmed, a system running PineScript crunches millions of data points instantly, organizing raw historical noise into clean, structured streams. This ingestion pipeline is the critical first step. It turns a chaotic history of prices into a structured database that an algorithm can actually use. Once the data is structured, the pipeline starts hunting. It's programmed to look for specific mathematical anomalies that are invisible to the naked eye. To a human, a stock chart looks like a mess of jagged lines, but the algorithm is different. It's detecting repeating geometric patterns that suggest where the price is headed next. Identifying these patterns allows traders to build automated rules. They can program the system to enter a trade the moment a pattern forms and exit the second it breaks. This is the core of modern risk management. By predicting these breakouts, these systems can capture gains or pull capital out before a sudden market crash wipes them out. One of the most famous patterns these algorithms are coded to find is the Darvas box. This logic was pioneered by Nicholas Darvas. He developed this method on Wall Street decades ago, using pen and paper to find order in the market's movements. The math is straightforward. The system draws a literal box around a stock's recent highs and lows. It waits for the price to burst through that top boundary, signaling a massive shift in momentum. A person might spend all day finding one of these boxes, but these pipelines scan thousands of stocks every second, identifying these specific setups with a mechanical consistency that no human trader could ever match. We see the erratic tickers on the front end of our apps, but the professionals are focused on the calculated back end of the data pipeline. Modern trading relies on these engineering workflows to replace emotional guesswork with a strictly mathematical framework. It's just data pipelines in action. Subscribe to 2 Layman data engineers for more secrets on how this code actually works.